Welcome back to the Rate of Change with York Wealth Management. As advisors to some of the wealthiest families in the country, the Rate of Change is a podcast designed to help you in the pursuit of building long-term wealth through the insights of some of the brightest minds in asset management. I'm your host, Murdoch Gaddy, and in today's ROCast, we're speaking with Cameron Brownjohn, the CEO at Federation Asset Management, about investing in mid-tier Australian private equity. If you're an investor familiar with private equity, or this is your first rodeo in exploring this asset class, and I think you're really going to benefit from Cameron's experience and insights. Federation has roughly $2 billion of funds under management, in which institutional investors such as Blackrock, KKR, Goldman Sachs, Suncorp, Hesta, family offices, and more comprise of roughly 85%, whilst the remaining 15% is wealth management investors. Cameron unpacks some of their investments, such as they have Australia's third largest childcare REIT, a disability housing REIT, Australia's largest battery, wind farms, financing businesses targeting the Australian ageing population, mid-tier private equity as a whole, and we discuss whether or not nuclear energy is a viable solution for Australia. The institutional business has been targeting a return on investment per asset by the time it's sold of roughly 60% for the life of the asset, whilst the Federation Alternative Investment Fund 2 for both wholesale and retail investors has averaged 17% for the past 12 months as of time of recording. Before we get into the conversation, please remember this podcast is made for entertainment purposes only and not to be construed as any form of advice. I encourage you to listen to the disclaimer at the end of the ROCast and to keep your feedback coming. You can reach me at mgatty@ywm.com.au. So, with that being said, I hope you enjoyed this conversation as much as I did, so sit back, relax, and enjoy. Cameron Brownjohn, welcome to the Rate of Change with York Wealth Management.
For having me.
Why don't we kick things off and just telling us a little bit about yourself and how you got into financial markets?
Thank you. I'm a 47-year-old father of four. Wasn't always, of course. Graduated from university, studied commerce and law, and took a job at one of the global investment banks. I was fortunate enough to work with those guys around the world, so I spent time with them in their New York office, in their London office, in their Hong Kong office, and of course in their Sydney office. And sometime early enough in that journey, they moved me from advising clients across to managing the firm's balance sheet. I guess I got poached ultimately to join the Macquarie Group. Worked for some of the famous people there at Macquarie, and in 2018 was fortunate with a group of the Macquarie team and I, where we decided to go out and invest for other clients, not just Macquarie's balance sheet, and hence Federation was born.
That's fascinating. To run a balance sheet of a firm. Look, I know we're going to get into Federation and private equity and all that side of things, but what was it like, literally going from advisors making investments to essentially running an entire company's balance sheet from the get go?
Running a section.
Like?
Running a section.
Yeah.
Look, it was great. It's nice to have reach and relevance and to put to work some of the things that you'd been working hard to learn in your career. I guess there comes with it a need to be right. In some of those seats, you won't be thanked for being wrong. So I think it was excellent. I've enjoyed my career to date, and certainly my time at Macquarie Group was no different.
The reason why I find this so fascinating is half the reason why we do these, conversations is to get to know the person, right? So we're going to get into the assets and what you've been buying and why you've been buying them. But I just find it's so fascinating, the journey about how you get there and, how that shapes the way you think. So do you find that having that experience of learning essentially how to run the business first and then seeing, as you said, the ramifications of the decisions, the good, bad, the ugly, and the impact that has that molded how you think about investing in these private equity businesses?
I guess listening to your question there, sort of two things sprung to mind. One was don't lose money, and the other was just kind of this journey that you're probing at. What I've enjoyed the most about it. Yes, I think investing in investment banks' capital into the sorts of exactly the same things that Federation does. Probably myself and my team have just been trained to look for downside protection and to try and find a way to not lose money before we turn our mind to how we will make money. So probably now wired to not be one of those teams that tries to swing for the fences and make 10 times our initial investment on a deal and then the next deal lose money. So we're probably not suited to venture capital. There are some venture capital firms that fully expect to be losing all of their capital on 30% of their deals, but they hope that their really good ones make that and more for them back again, so that as a portfolio they can do really well, and they'll unashamedly tell their investors, well, if we're not losing money on a deal, we're not taking enough risk. That's a very different way than the Federation team and I have been, I guess, through that journey wired to think. So don't lose money would be our key area that we start from thinking about, and then we try and grow our capital or our clients' capital from there. The other element.
Sorry, go ahead. No, go on.
I was just going to say the other sort of element that you're probing at with these early questions is kind of like my career and what was it like, and what you kind of almost from a certain perspective, what do you most enjoy out of it in terms of that would have therefore shaped the direction of where you headed. And I've thought about that question a fair bit. At least I've been asked variations of it in the past as well. And my answer is definitely I've enjoyed working with entrepreneurs or families or people that have built a thing. And I guess was always fascinated in these people that have grown a business or grown a portfolio of their own investments or gone out and achieved something notable in the business world. And in the seats that I've been able to sit in for people like the Macquarie Group, I've got to spend a lot of time with these people, sort of fly around on planes and try and buy businesses or do something together. And so get to know them quite well over dinners or just traveling in taxis or whatever it might be. That probably was a key reason why in my early 40s, I left Macquarie to be a founding partner of Federation, because probably my appreciation for those people who've gone out and done something to grow something probably led me to also want to have a go. And circa 20 years, maybe a slightly under 20 years into my career at that time, it felt like a good time to do it because, well, firstly, I'd been working together for a long time with the teammates that I left to start Federation. So we knew that we worked together well as a team. I'd made some good investments and figured that others that were aware of that would potentially back Federation with some capital to allow us to start. And then also, I guess, just in terms of running these investment teams at these places, and ultimately I was running Macquarie Capital's principal and investment team out of headquarters for this region. I guess I'd seen what not to do as well, and probably have those life lessons and investment lessons in my mind. So felt like it was a good enough time to start.
Yeah, I couldn't agree more. The expression is you can teach finance, but you can't teach experience.
That's probably right.
So Federation, what, in a nutshell, for someone that's not familiar with the firm, what exactly do you guys and girls do?
Thank you. Federation's a private capital firm based in Sydney, Australia. We focus on investing in businesses and assets that meet social and economic needs. At the moment, most everything has a nexus to Australia, although it need not necessarily always be so into the distant future, because some of this team have experience of working around the world. We manage a little under $2 billion of client commitments, and there's 23 of us right now. I guess the key areas of expertise that people would know us for are threefold. One is mid-market private equity. So we have a very strong track record in mid-market private equity, and over all realized exits that we have achieved as a team. So cash getting back into someone's bank account, not some spreadsheet saying that values have gone up. We've achieved 60% gross IRR in aggregate, now into our 14th year. The next of the three areas that we're notable for is sustainable infrastructure. So we have a different team of people that own, we think, Australia's best renewable energy platform. We own one of Australia's biggest batteries. It's big enough to fuel Canberra, but we don't fuel Canberra with it. We have contracted it, fully contracted these assets. And that asset is half contracted to Shell, inflation linked for over a decade, and the other half is contracted to Energy Australia, inflation linked for 10 years. And we've got another generation asset, again, fully contracted. So we've got an infrastructure team that looks for fully contracted inflation linked cash flows. And that team has done very well in infrastructure. Their track record is 23.5% gross IRR on realized performance. And that is in infrastructure excellent. And then the final area is real estate. Some parties consider it social infrastructure, the areas of real estate that we're investing in. I guess in short summary, we have from scratch built what is now Australia's third largest childcare REIT, and probably Australia's largest NDIS REIT. So these specialist disability accommodation REITs that you read about in the paper. Federation would manage probably the largest, if not the largest, it'd be the second largest, and Macquarie would have the largest of these things now. And both of those asset classes are performing incredibly well for our investors as well. So mid-market private equity, and we also have real asset pools of capital as well, probably that play the same sort of thematics that we do on the private equity side, but just on doing it on the real asset side.
Lots to unpack there, and we'll get into that. But I suppose what people just kind of want to get their head around a little bit is people listening to this are probably high-end family offices, incredibly wealthy people, but there's also a number of people there that, retail investors or normal wholesale mums and dads or something equivalent. So one of the things we're discussing off air is you have an ability for different types of investors to access what you're doing. Do you want to break that down and how the mechanics of that work, please? And the other reason is you're saying 60%, right? But then when you go and look at the returns, it says something different. And if you could explain that, that'd be great.
The returns in the unit price of
Correct.
the more recent unit trust for wealth management channel. Yes. So to explain, about 85% of Federation's capital comes from institutions, and the remaining 15% come from perhaps people that are listening to your podcast and others like them. Generally speaking, the wealth management channel, people that may manage their own money, people who are in family offices, people whose financial advisors have decided to allocate a section of their portfolio into the things that Federation's doing. it's probably fair to say with our institutional clients, we tend to lock them in for a period of time. Most commonly across the industry, they're committed for about 10 years. And it is the same for the things that Federation does for our institutional clients. Generally speaking, these people commit to us for 10 years, and we try and do a good job for them. And at the end of the decade, give them their money back and hopefully their profits with them. It doesn't work the same way in wealth management. We have in the past, and certainly in our first wealth management fund, given a 5-year version of the same thing, takes people's money, do a good job with it, but lock it up and not allow redemptions for 5 years, give the money back and hopefully the profit with it. And that's certainly the way it's looking like, behaving in both of those instances to date. But a little over a year ago, we were asked by a range of our clients to provide a liquid private equity solution. And it's this liquid private equity solution that has been performing to an annualized rate of return of 17% on a mark-to-market basis, on a net basis, after performance fees, after management fees, after costs, after everything. So net returns, share price, kind of equivalent related to the investor's perspective. But that's only been it's only been in existence for a little over a year. So firstly, 14 years of track record and 1 year of track record are different things. This thing has been achieving a 17% net unit holder rate of return since inception. And the difference to our institutional products are that investors are able to access this fund every single month, and they're able to redeem every single month. And we have to therefore set the unit price every single month. It's the team's most favorite day every month, where they have to value their portfolio companies, and our valuation committee signs off on those valuations. That's an independently chaired valuation committee, I might add. And it's that work that trickles down into the maths of what our unit price might be every single month. And we invite and permit investors to increase their allocations, or for new investors to join at that unit price. And we permit people to redeem under the terms of their redemption mechanism with us every single month at that price. No fees, no costs, no drag. If people want to get out, they can get out at that same price that people are getting in as well. We've been asked how we manage this liquidity, and we can, of course, go on and explain that we've got a diversified portfolio and there's a natural cadence of portfolio investments rolling in and out of the portfolio over time. That's, of course, true until it is not. So ultimately, we need a logical end game for how we fund our redemptions. And in our instance, it's cash. And so the simplest way to think about it is that if redeemers want to redeem, they get the first call on the cash available in the tin before the next cool investment the team wants to do, I guess, in short summary. And like other versions of this same thing, there are others that provide liquid products. Generally speaking, they're the global investment houses, someone like Partners Group, someone like Hamilton Lane, someone like Schroders. They all have versions of a liquidity mechanism, usually monthly or quarterly. In our instance, it's monthly, so we think best in class. In the same way as others in the industry find it within private equity prudent to cap the level of redemptions so that you don't have a Mary Poppins style run on the bank. You need an ordinary orthodox exit of a private equity portfolio if it is that you are to achieve full and fair value. The redemption mechanism is therefore capped at 5% of NAV per quarter. That's not to say you can get 5 cents in the dollar of your money back. That is to say that we think less than 5% of unit holders would want to redeem any given quarter. That's certainly been the case in our history. I guess it's not until it is. And so you need some very clear guidelines as to how much the redemption capacity will be capped at. So does Partners Group, so do the others. And we are industry standard in providing that liquidity up to 5% of NAV per quarter.
Not to toot your horn, but look, in all seriousness, 17% is not to be sniffed at. And I'm a big fan of private equity and the ability for companies you may recommend are high quality other firms that give access to this particular asset class. I think it's fantastic, but there's a big gap between what other people are getting returns wise to 17%, and I just want to make that incredibly clear, because 17% isn't exactly normal in this space unless you're going physically directly into the asset class and you're removing all the middleman stuff, right? So do you want to give a bit more clarity? And I think we discussed it off air, how it works. But do you want to give a bit of clarity on that? And then we'll get into the fun part, which is, what actually are the assets and, how you actually bake this cake.
Okay. Well, 17% is below our realised track record. And we certainly hope to continue to successfully build wealth prudently for our investors. Thank you for the pat on the back. We're pleased with how we're going, and we would hope that our performance will at least achieve the same level and ideally improve from 17%, because it's below where we've sold companies, and it's below the latest exit that we've had, which I'll speak to in a second. I guess when you're valuing your portfolio every month, investors will be certainly unhappy if I overpromise and underdeliver on our returns. And I think there is therefore probably a minor bias towards conservatism in how we value the underlying assets. I don't want that to sound like we're sandbagging the portfolio, because we certainly are not. We are trying to find fair value every month. And we are hand on heart, and our valuation committee is hand on heart, believing that these valuations that we set for each portfolio entity is fair. But if you are on the bias of conservative or aggressive side of those marks, probably history has shown we're on the conservative side. There's probably a key reason for that being consistency of valuation approach. So one of the way private equity firms make money is to buy well. Another way is to manage the companies well. And another way is to exit well. There's a range of other things people can do. You can use balance sheet to buy growth. You can do all sorts of tricks, but at its simplest, buy well, sell well, and manage well in the interim. So we certainly try and do that. And the valuation parameters that we use entering an investment, we will stick with in how we're valuing a company through its life cycle. I'll give you a hypothetical example. Let's say a healthcare facilities business, hospital or hospitals company. We do not have one in the current portfolio, but we do know a fair bit about that asset class. Let's say if we were to buy a hospitals company, we might think that a key valuation parameter might reference, say, its EBIT or its EBITDA. And so we would look at a basket of other hospitals companies, people like Ramsay and Healthscope and others, and we would reference, say, where their multiples are trading. And let's say I'm not sure where Ramsay is at the moment, let's say 12 or 14 times EBITDA, and we've entered our investment at 8 times EBITDA. So a discount to where the prevailing comparable companies are valued on the stock market. We would retain that discount over the life of our investment. So if Ramsay goes to 20 times, we may mark up our parameters that we value the earnings of our company for every given month, but we won't mark it to 20 times. We'll keep that same pro rata discount. And so conservatively, probably marked versus bouncing it straight to, we've bought this thing wonderfully. It's definitely worth 14 times and we've paid 8 times. Let's mark it straight to 14 times. Because who knows that that's right? You need evidence and time to confirm that that's right. And there's no rush to confirm that that's right. The only time the proof will be in this pudding is when you sell that asset. And so that's, I guess, probably why, one of the reasons why there is a difference in 17% and 60% of a gross realised IRR in what we've achieved in PE historically. The other obvious one occurs to me is just time period, 14 years of data versus 1 and a bit years of data. You know, there's going to be some fuzziness in that there. Turning to sorts of investments that we're doing and maybe starting with this latest exit that we've had, which was a contract research organisation. So it was a healthcare business, a healthcare services business. It's called George Clinical. We invested in this business in November of 2019 after about a 4-month exclusive due diligence period. So this company came to us seeking some growth capital, and we, which was nice, we were approached exclusively. We were known by this company as someone who could help them with our knowledge of healthcare services and things that they were wanting to do with their growth of this business. And fortunately, in our background, we had directly been invested in a company with a contract research organisation. So kind of recommended that we were good enough people to work with and that we could help them with the things they were thinking about. So coming to us was nice. Doing 4 months of exclusivity to really get under the hood of the business was nice. And then ultimately investing in them was nice too. Through that due diligence period, we, I guess, wanted to believe the things that management were telling us would happen with this company. We wanted to believe that the growth and their business plan would manifest, but we were worried about a couple of the factors that they were telling us that maybe wouldn't come home to roost. And so it would be fair to say that they thought EBITDA would be here, and we thought there was a risk that it might be slightly lower. So we explained to them that, look, we really liked the business. We really liked the shape of what they're doing. We really liked the evidence of what they'd all done before. And so we wanted to give them the money to achieve the business plan that they wanted to achieve. And we wanted to directly plug in with our operational skills to help them do it. Excuse me. And we thought that would all work, but we were worried about being edge of value equity at the price that they were asking for. And so we said, look, 2 things. We can give you money at a different price, or it would be actually our preference to just put our money in as a convertible note, a debt. There was no debt in the company of any consequence. So put our money as first lien debt, first dollar out. But importantly, to retain this equity optionality. So a debt that can convert into equity, a convertible note. And we said, being debt, and this note, by the way, was a 5-year convertible note with a 4-year conversion period. So that allowed us to be on the board, have excellent information, inside information on what the company was doing. Great transparency on all of their reporting, direct working relationship with CEO, CFO, and their teams. But importantly, be debt and protected, way away from the edge of value. Through that debt-like period, we negotiated an 8% coupon. But we explained to the management team, and they got it straight away, that our investors are not giving us money to achieve an 8% rate of return. We want to believe in the equity story. So we were positively predisposed to converting to equity. So if all of the things that the management team's saying and will happen, we'll of course convert to equity, and then they'll get the money that they wanted at the price that they wanted in the first place. So it's kind of like, here's the money, back yourself. And if all these things that you're saying are going to prove to be true, then you'll have, like, it's all the same to you, because we won't be dead anymore. We've converted to equity at the price that you wanted. So and you know what? To their great credit, they did back themselves. And to their great credit, they were right and we were wrong. Like, the earnings was we did get that and more of what we all hoped and dreamed would happen with this company. And on the way in, Bupa, the global healthcare investing company, sort of saw what we were doing and liked that and came in alongside of us. And I guess we were fortunate to credentialize ourselves with that. And it's a good evidence of this, I guess, federationness of what we can do with our clients' capital. We commonly blend our clients, our wealth management clients' capital, in this instance with institutional capital. In this instance, Bupa came in alongside exactly the same thing that our wealth management clients were doing, exactly the same terms. So how did this business go? We were in it. We entered in November of 2019 and we exited ultimately in July of 2023. So we're in there a bit over 3.5 years. And over that, I'll note those dates, 2019 to 2023, COVID happened in there. I've heard lots of people complain about operating performance of companies through COVID. Well, this one, we grew by 3 times. We grew the earnings of this company by 3 times, including through COVID. And it wasn't going that well through COVID. People weren't doing drug trials through COVID, but we didn't lose any contracts. And in fact, we gained and grew the business, at least their contract book, materially through the period. And so had all of the right settings and systems and processes and cash flow management, cost controls, but all still the same settings for growth that you would want in a growing company, all kept pretty integral even through COVID. So it was that when it came out of COVID, which inevitably was always going to, it performed well. And earnings between our entry and exit trebled. Without M&A, we didn't go and buy things. People can go and say, my M&A is 3 times, but if you put 3 times as much money in, there's no scale on your equity. We did not have to do that. 3 times earnings without buying it, 3 times earnings through organic growth. And to my earlier point around buying well and selling well, when we exited, yes, someone paid a higher multiple than we did on our entry. And so the money multiple that we made for our investors over 3 and a bit years was 4.7 times money. So someone gave me $1 million, I gave them $4.7 million back. And that is an IRR of 59.8%. So sorry if that was a long-winded answer.
No. I actually prefer this. I find this fascinating. So how big was the convertible note? I don't know if you can discuss that.
It's of less consequence.
And what percentage of that? But the reason why I'm phrasing that question, right, is what was the percentage of the $2 billion? Because then that determines as well, how it moves the needle on the other end.
I think the way I would have you think about Federation's sort of hitting zone in mid-market private equity is kind of $20 to $50 million checks. And so our businesses often might be, say, 200 and at the upside, maybe $500 million of enterprise value. So they're not new companies, they're long-term successful companies, and they've kind of grown to that $200 million of earnings or so. And probably $200 million of capitalized value or so. And it was sort of a similar consequence here. To answer your question strictly, convertible notes were about $30 million into this business. So perfectly suited for a growth equity investment. Importantly, with Federation, we can be more than 50% of the equity of a company, and we're equally happy to be less than 50% of the equity of a company, as long as we have the key package of controls, positive or negative, depending on the circumstances that we require, and or if we can find mechanisms for this downside protection, just like we did with that convertible note in this instance. But short answer, it was a $30 million aggregate convertible note tranche.
I find the mechanics of how this all works, fascinating. I'm quite familiar with it, but a lot of people aren't. So you have 4 years term on that convertible note. You bought in 19, sold in 23. When did you actually convert it to equity?
We didn't need to convert until after the sale agreement. So with certainty.
Really? So you can potentially organise the sale, get everyone backed in, and then decide you can still convert in the sale of that process.
Yeah.
The amount of downside protection to do that is huge.
Yeah.
Now I want to know about the other businesses that you've been buying. Actually, one other thing, which I just wouldn't mind you explaining, the universe and the landscape. What exactly, for a lot of people that aren't familiar with this, is Australian mid-tier infrastructure? Does it include toll roads? Can you go anywhere, or are there some things you're like, I just don't want to participate in that space?
Well, we have done toll roads as a team before at Macquarie, but no, Federation is mostly interested at the moment in this renewable energy boom that is going on in Australia and other parts of the OECD, where some people in your program will be happy to hear that, and they'll think someone's out there doing a good thing for the planet. Some people listening to your program will be climate skeptics, perhaps. From our perspective, we aren't doing it just to make the world a better place or not. We're doing it because you can build things into an area of need and people will sign long-term inflation-linked contracts for you to do so. So we're doing it to make money for our investors. And it's an important point to highlight to your listeners. We think first and foremost around how to protect our investors' capital and how to grow it. We are pleased as a team that in the areas that we play, we are doing things to help make the world a better place. The healthcare example I just spoke of, we talked around mechanics and business and return profiles and $4.7 million for every $1 million. But that business itself is one of the world-leading entities involved with renal dialysis. And it has also non-trivial involvement in areas of cancer care. I mean, that's a cool thing to be involved with and help to grow. And so in renewable energy, in short summary, or in infrastructure in this country, the only things we've really done at the moment is we've bought into the former CSIRO Wind Science Division, and we're helping to grow it. So it previously was government, it then commercialized, it then IPO'd, and Federation took it private in 2020. We've grown that business material, and I'm happy to talk about that if it's of interest. And then we also own one of Australia's biggest batteries. And we're doing these things because corporate Australia really likes the ability to lock in long-term energy purchase agreements from us. And we like that because they'll just pay us. Well, it's like the rent. It's like they rent the capacity of these things on an inflation-linked basis for a long time. Our most recent power purchase agreement that we signed was with Rio Tinto, an A-rated company, a mining company. And they signed that agreement with us for 25 years. And they did it on a 1.2 gigawatt slice of assets. It costs about $2.5 million per megawatt to build a wind farm. So they did that on $3.5 to $4 billion asset. They have underwritten a $3.5 to $4 billion asset for us over 25 years, inflation linked. That's good business, and we'll do that as much as we can.
That's huge. Do you want to walk through, how that works and give a bit of color around those assets?
Okay. Excuse me. So WindLab's the wind farm platform. It was formerly a listed company, as I mentioned, and Federation privatized them in 2020. And in fact, our wealth management clients' capital co-invested alongside Andrew Forrest's Squadron Energy. So we own that business with Andrew, and we have since 2020. And I will note that they've been good partners. And we've invariably agreed with most everything at the board table. And Andrew and his team have been good to work with for the avoidance of doubt. So it's been a happy, symbiotic relationship where we've all brought things, hopefully, to the table consistently and well. The business, when we bought it, we just thought the listed market was pricing it improperly. Kind of the listed market didn't get it. And there's a number of instances where history will show that to be true. And this one is another one of them. So when we bought it, it had assets and operations in Australia and the United States and some countries in sub-Saharan Africa. And we kind of working through with the management team and said, if you haven't noticed, there's $150 billion worth of deployment in the next little while in Australia because the coal-fired power stations are becoming too old and they are being switched off because they are uneconomic and they're breaking down and their shareholders are no longer making money or as much money as they need to out of these things. And this capacity is being replaced by renewable energy. It's not a matter of whether it should be or not. It is being replaced by renewable energy. Why don't you just focus at home? There's so much to do. Don't be distracted with these little things you're trying to do in America and these other random countries in Africa. And they said, you know what, fair enough. And so we sold out of the international assets. And to my earlier point of the listed market not pricing WindLab properly, well, the random non-core international assets, we sold them for more than our entry price in WindLab in a year or so. So within a year or so, we had got all of our money back from our initial investment and then some. And we've created Australia's biggest and best WindLab or wind farm platform for less than free. And we've then materially grown it, by a factor of 5 or more times the development size of its book. And along the way, probably solved a couple of problems in there that we inherited. So a couple of things when we were buying in were multiple years late. Well, one of the reasons the management team, I guess, wanted to work with us is that we've got some skills to bring to bear into that sector too. We've fixed those problems and those assets are now humming along at nameplate capacity and working properly. So WindLab so far has been a happy investment. We continue to hold it. We haven't exited it. And I'm not sure that we have plans to exit it. Obviously, you would always be mindful to sell it at the right price at any given time. But if I had my preference, we would be in WindLab for a while's longer yet, because this renewable energy wave is only really starting. So that's one example. Maybe I can give you more if you want, or we can I'll follow your lead.
No, I find the beautiful thing about this conversation is you it's like an onion. You pull back one layer and you just keep going. What's left? Go on tangents. Where my brain's running over here, I do have one question for you, since you're in this renewable energy space. What is Australia's, as you're saying, you're investing in assets that essentially Australia is backing, and hence they're paying you for it, which is fantastic. But I've had a number of very interesting conversations regarding what's happening with uranium, nuclear power, these smaller reactors that are half a football field. Is there a place for nuclear powered power stations generating very clean energy in Australia? Is that even in conversation? If it was in conversation, would you look at that asset class, or is that currently, a no-no because people just still remember Fukushima and Chernobyl, and they just can't get their head around it? What's happening in that space? Because it sounds like that's the solution to most answers, and the UK is putting in how many?
Yeah, thank you. Gee whiz, politicized topic. Half of your listeners will like what I'm about to say, and half of them will hate it. I'll try and not express it, my answer from a political perspective, but just sort of focus on the realities of and the pragmatics of what we're trying to do. I guess in very short summary, nuclear on a levelized cost of energy basis is more expensive than renewable energy sources. Nuclear has a range of tail topics that need to be thought about, not just by a company, but by a country, like how you deal with waste, etc. And you will be able to live in the community with a wind farm if it doesn't go the way you think it will. You won't if that happens in nuclear. So it's not even difficult to say that nuclear is more dangerous. The tail risks with them are profound. If it is that nuclear becomes an investable asset class in this country, I think it will be a very long way away. And if it becomes an asset class at all in this country, I think it should certainly be the preserve of government, not the private sector, for a protracted period of time. Because the private sector is driven by other motivations, like making money for their clients. And I certainly don't want to be living or having my family live near a nuclear power plant if profit motive was one of the key topics. So, yeah, more costly, not as effective, and dangerous. Now, a lot of the world have nuclear power stations, and so that's obvious that a lot of these other markets are bringing them to bear or have them to bear. And yep, nuclear has been around for nearly a century, and so hopefully some of the ills of the past have been learned from. So we should certainly, I can see why there is a debate at national level for these things. I will make the point that Australia's got an enormous geographic landmass. England doesn't. So just because England's looking to find a fuel solution that fits them, by the way, England's had a nuclear power industry for a very, very, very long time. So it's potentially more obvious for them to think of bolt-on solutions to it than we do. Because we've probably got an ability to consider nuclear, but we don't have an entrenched industry like they do. But England doesn't have as much land as we do. We've got heaps of land. And so the relative efficiencies of one industry to the other, and then the background and legacy way that the grid has been fueled in these countries should also be considered when the debate turns to just because they're doing it, we should do it too. So that would be my view on nuclear. And probably it isn't an active topic for Federation to be talking about, because we cannot, in any realistic timeline, even if it was going to be the next greatest thing since sliced bread, deploy our clients' capital into it. And we certainly wouldn't be the first to invest into the sector. And so this is a topic for very distant future, I suspect, in this country, pragmatically.
No, it makes sense. Just trying to get an idea of what you will and what you won't do. But it's also a very interesting topic on, what's happening, around the world. And you're mentioning, renewable fuel sources. And my thoughts on this, and yes, it's politicized, is essentially there's a game being played at a very large level. Yes, sometimes it's cash, sometimes it's power, sometimes it's leverage. But, you can't, when you have, one country or 4 countries that control the gas supply and the oil supply of a very large portion of the world, and others don't. Well, if you want to survive and a war comes, hasn't been one for a very long time, like a global one, you need to wean yourself off particular resources and make yourself self-sufficient. Not necessarily a problem Australia has. That's why I was just, curious, considering you're looking at it not from a politicized lens, but, from a business side, as, what will make us money and, what is Australia backing? I was just very curious. And I appreciate your, thoughts on that matter. What asset, haven't we discussed? Well, here's a better question. Since you've just sold an asset, is there anything you're looking at now? What catches your eye in opportunity land?
Yeah, we're working. The team's pretty frazzled. We worked pretty hard even through the Christmas break, and often investment teams might get a bit of a break through Christmas, but it wasn't thus for us this time around, unfortunately. So, yeah, the team's running pretty hard at some of the things in front of us. I would think we would be known as having skills in some of the sectors we've touched on today, but there are other ones that we would be known for having skills in. One of them is in financing businesses. And we really like the idea of applying financing now to the aging population thematic. We like the idea of businesses that allow retirement age Australians to access the latent equity value in their home. There's been a finite range of these products historically done in this market, things like reverse mortgages, or things like Bendigo and Adelaide Bank's equity release business, HomeSafe, which takes upside in people's homes, basically buys a bit of the future sale proceeds in them. We like that sector. We did that sector when we were at Macquarie, and we think there's profound opportunities to grow that sector in this country. Australia relative to Canada, for example, we're well behind them in what we do there. Australia relative to England, they've got their nuclear power industry. They've also got a far bigger senior financing industry than we do here. And so we like that area, and we think that it's a direct area of service to a growing need with aging population, and we think we can do it well. So we've been in and around that space, looking at all of the various ways to play it. And that would be, I think, at the right time and right terms and right price, something that I think we'd be very interested to do. We continue to grow what we're doing for our clients in real estate as well. So from scratch, we've built now Australia's third largest childcare REIT and largest, I guess, home builder for people with disability, and the NDIS pays the rent there. Both of those things are resilient through an economic cycle. So we mentioned COVID earlier. Both of our REITs got all of their rent on time and on budget through COVID. No discounts, no delays. And so that's not many people can say that. And that's a good and rigid way that we can stand in front of our investors and say, look, the growth trajectory of these things are good, and they're robust, and they can weather the storm.
But on the childcare one, right, one of the other firms that I'm familiar with, they had a big problem in New York. I think they were the largest childcare in New York. New York got shut down. And it was to the point, it was actually, during COVID, it was their main asset that, had its head knocked off, and they had to reach in their pockets, refund it, boost it all up. And now it's looking fine now. But I just find that very interesting that happened in New York. And you're saying that you're the largest, in Australia. Australia's fine. New York got his head knocked off. Like, what was the main difference?
Third largest. We're the third largest.
Third largest. Apologies.
The two bigger ones are listed. There are a number of differences between the two markets, including the way that you're paid. So there's a degree of bipartisan governmental support for childcare, women in the workforce, kind of thematic in this country. That's not necessarily true for other parts of the world. And then just in the instance of COVID, the ability for people to leave their apartment in New York and access services like childcare was different to experiences in our market. In any event, we are one step protected from this risk of whether kids will turn up or not. We're not the operator, as your reference in New York might have been. So we don't teach the kids how to count and feed them macaroni. We're just the landlord, and the operator pays us the rent. So they're taking the first line of attack from whether 100 or 50 kids turn up on any given day. I don't care. They're going to pay us the rent. And the rent is backstopped by bank guarantees, and those bank guarantees invariably are cash collateralized. And this is a key reason why we want to be working with the big and good care groups, so the major childcare brands that you would see in the market, not the mum and dad shops who might have gone bankrupt if it was that we, forced them to keep paying the rent. The big companies that we were dealing with, look, it's why we wanted to deal with them. They have the financial resources to weather that storm. So why should we weather it for them was really the policy that we took. Look, they explained probably some of our shortcomings to us around that policy, but they missed most of them. And they missed most of our shortcomings, but they paid the rent, and they had to, because that was what they said they'd do. So that's probably a key difference. And so both of those real estate investment trusts are doing well for our investors. Blackrock is our major investor in what we're doing in childcare. They like it because they think it's a cheap version of the two bigger listed ones, and they like that we're growing faster than those listed ones. So hopefully, if we keep going the way we're going, we'll catch up to those guys. And Blackrock think it's great that they can access alongside our wealth management clients, the same sort of thing that they can through an arena, but cheaper. And similarly, on our disability housing REIT, KKR have recently signed on as an investor. Goldman Sachs was an investor before them. Hesta, Suncorp, some of the major foundations and families in this country, and our wealth management clients are invested in that. So I guess 2 data points again of people listening to your program and their ability to access assets alongside, in parallel, no fees on fees, same pro rata rights as the world's biggest and best institutions.
Yeah, no, it's pretty interesting. I could keep going this all day. I'm just conscious of time. The one question I love finishing on is, what keeps you up at night and what gets you out of bed in the morning?
Yeah, I think we think a lot about maintaining our settings and our footings and where we're going as a business for our clients. And at a business where I guess we've been blessed to be provided a little under $2 billion of client money to date. That's more money than my personal balance sheet, so it's a lot of money. But in the world of asset management, in the sectors that we're playing in, it means that we're up and out of the ground and we're profitable, but we're at the stage where we need to be a shark that keeps swimming to survive. So continuing ability to find ideas and do good things prudently for clients, we think heavily about. The other thing with these firms, you're only as good as your people. And so we think really heavily about making sure that we're a employer of choice and a place where people are heard and valued. We really try and have a culture that's got a flat structure and kind of a sense of we're all in it for the right reasons and pulling in the same direction. And I would give us a relatively high score out of 10 on how we think about both of those things. We try and be thoughtful as a business. In terms of things we're worried about from an investment perspective, if that's where your question was coming from, I think we're
could just be kids, mate.
Well,
could just be not sleeping.
I think about my kids all the time. My children are 17, 15, 13, and 11. I have 2 boys and 2 girls, and they're all different people, and they all have different interests and different things they're into. The 15-year-old girl's going through things that 15-year-old girls go through, and all sorts of things. So that's a topic for another day. But they're all good people, and I love them dearly.
Fantastic. If anyone wants to learn more about Federation, how can they find you or reach out?
So the Federation website is federationam.com. We would certainly welcome the opportunity to meet with those of interest. And if we can be helpful, please do reach out. There's contact details available through the website.
Cameron, I really enjoyed this conversation, and I appreciate you giving me a lot more insight into what you're doing in private equity land. I really appreciate it.
My great pleasure. Thanks for spending time with me today, and have the good rest of your day.
Take it easy. See you, Cameron. Bye.
Any views expressed in this recording do not represent the view of any other third party and are the sole personal opinions of the speaker. Any reference to financial product does not constitute advice or recommendation, and before any action, you should seek proper advice from your financial professional. Australian listeners should head to www.moneysmart.gov.au to find more information on obtaining financial advice. To get in touch with York, head to our website www.yorkwealth.com.au.